be recorded.
Thank you for joining me. My name is Steve Tuttle. I'm a portfolio manager and partner here at Signet Financial Management. I'm going to discuss some key takeaways for investors that we've seen so far in 2018. I'll start with a quick chart that goes back about 12 months, 13 months actually. And what we see is 2017 was a fairly smooth, steady ride up. And then coming into 2018, we had a sharp increase and then a quick drop lower. And since then, we've been in a very choppy market where the market appears stuck in a trading range. Although July, the month just completed, was a very positive month, the best month we've seen since January. So let's start discussing U.S. stocks. We believe the bull market, which has been going on for about 10 years, still has legs. In part, this is driven by a very strong earnings outlook. This earnings season has been particularly strong, and we believe that should extend the bull market further. In part, strong earnings are related to the tax reform and tax cuts for corporations, which is helping corporations boost their earnings. On the other side of that, and in part why we haven't seen the market spiking up to new highs recently is related to some trade tensions and political uncertainty that's overhanging the market right now. Summing it all up, however, we're very conscious of valuation and price over the next 3 to 5 years, and we think there are still some good opportunities out there to take advantage of markets. And specifically, we like to look at areas which perhaps have been left behind unfairly by markets, and so we look for mispricings. And one area that we think is attractive right now, and I know Eugene's spoken about it many times in his pieces, is growth at a reasonable price. So we're looking at stocks that have a really nice combination of earnings growth, profit margins, and attractive valuations. And fortunately, we're still finding plenty of candidates that fit those criteria. If you look at foreign stocks, the economy is very much a global entity these days, and global growth is positive, although it has slowed a bit from a pretty strong showing in 2017. Foreign markets, both developed economies and emerging market economies, have been down year to date, so that's been a little bit disappointing. However, periods of weak returns can offer a place to hunt for bargains, and we view foreign markets this way. Relative to the U.S. markets, there is a gap between U.S. companies, which are a little bit more expensive on a PE ratio, than foreign companies, which seem to offer lower valuations. And here's a quick chart that talks and shows how the performance between U.S. markets and foreign markets has very much been a cyclical occurrence. And you'll see in the blue, when the chart spikes to the high side, that's when international markets have outperformed. And you can see there's been many long periods of time when international markets outperformed the U.S. The gray areas where the line is going below, that's where the U.S. market is outperforming. You can see we're in a period right now of about 102 months where foreign markets have lagged and U.S. markets have surged. How long can this last? Not exactly sure, but we are encouraged that this trend probably won't continue forever. In terms of bond investing, without a doubt, we think the story in 2018 is rising rates, particularly at the front end of the yield curve. Short bonds, CDs, T-bills, they're all now paying much higher yields than you could have received as little as 6 months or a year ago. In terms of recent activity in the bond markets. Because of this rising rate dynamic, cash, floating rate securities, and short-term bonds have performed very well. High-yield bonds have also performed pretty well. That's more related to the strengthening economy and strong corporate earnings. In terms of laggards on the bond space, emerging market debt, corporate bonds, longer-term, and longer-term treasuries have all lagged. So where's the opportunity? We think there's definitely an opportunity to take advantage of rising rates by laddering maturity dates. So setting up and purchasing individual securities with fixed maturity dates that are spread out over time. So in theory, you could have a CD ladder with a bond coming due every 6 months for the next 3 years. And what that does for you is as rates rise, you're somewhat protected from being hurt in terms of your principal because you have instruments that come due every 6 months that you can receive the cash and then reinvest at higher rates if rates keep rising. Other opportunities, we actually think CDs are attractive right now. It's not usually a security that we have invested in historically. However, with the Fed raising rates, and banks are competing very aggressively for deposit money. And the way they do that is by offering attractive CD rates. And that's what we're finding right now. So through our brokerage platform like TD Ameritrade or Charles Schwab, we have access to CDs through multiple banks, hundreds of banks as a matter of fact. They're FDIC insured for safety. And they are currently offering nice attractive yields relative to treasuries, and they're really not that much lower than corporate bonds, which come with credit risk. So we like brokerage CDs for offering safety in the form of FDIC insurance and attractive yield. On the other end of the spectrum are BBB rated corporate bonds. These assume some credit risk, although they're still investment grade. We're finding some attractive securities in that space, particularly among corporates and select municipals, which offer tax-free income. So we're focusing on investment grade, and because it's a little bit lower, BBB, not AAA, they are a little bit less sensitive to rising rates, which is a good thing in this environment. I do want to remind bond investors that bonds have typically provided a nice place to provide some capital preservation. They do a good job of balancing out portfolios with stocks or equities in them. And this chart just shows periods of time where the stock market drops 15% or more. So these are essentially corrections or even bear markets in the stock market, and it shows what during that same period of time how bonds held up. And in every case, you're not going to get rich or completely offset the downturn in the stock market, but it does a really nice job of protecting capital and reducing volatility. So I'm going to close with a few thoughts. One, we are very optimistic about our ability to navigate this environment. It's not an easy environment. There's definitely some challenges out there. We do believe global growth should continue into 2019. However, looking beyond that, out 3-4 years, the possibility of a slowdown or even a recession is getting higher. So it's something that we're wary of and watching. Income investors, I think there are some definite benefits from rising rates as long as you're careful about how you position your portfolios. And we think it's important to prepare for volatility. The choppiness that we've seen so far in 2018 is likely to continue, unfortunately. That being said, we're about 10 years into a bull market and risks are starting to rise. We think it's an excellent time to evaluate portfolios. I would definitely consider ways to rebalance, to reduce positions potentially that have performed very well, but now may be overvalued or they may have grown to a size that it's now creating more risk in your portfolio than you'd like. I also would use the opportunity to de-risk bond allocations. As I mentioned earlier, it's now possible to receive 2, 3, 4% income without taking considerable credit risk on the bond side. And so I think it's a great time to look at that. And finally, perspective. Maintain perspective. I think it's a great time to look at your investment goals and track your progress. To me, it's much more effective to look at what you need your portfolio to do and what has it actually done. That gives you a good sense of how you're doing, and it can potentially be a lot less stressful to approach your portfolio that way than to look at, you know, what the NASDAQ is doing or what interest rates are doing or what some foreign markets are doing. So a good advisor like Signet can help. Specifically, I think we can help you make informed decisions and make adjustments as needed to make sure that you're on track to reach your goals. That's what we try to do. So I want to thank you for your time and continued trust. Feel free to contact me at any time. If there was anything on this presentation that sparked some questions or some interest, please send me an email or give me a call. You can also follow us on Twitter at SignetFin, or go to our website. That's where we have a lot of good webinar videos such as this and other insights. So thank you for your time.